All right, well, I have top of the hour, so we're going to get started because I want to honor your time. My name is Jeannie Osnes. I'm a MAPS coach, and I had the privilege of writing a course with Gary Keller called Profit Camp. So I kind of specialize in agent finances, the P&L, things like that. And so MAPS asked me if I would do this course on the 5 biggest profit mistakes. So first, I want to make sure that you all know this call is being recorded. And once the recordings are done, we will be sending this out to everybody who registered for this course. So if you want to be able to watch it again, you're going to have that opportunity very soon. Also, I'm going to say it now, but I'll say it again later. We're just going to touch on 5 key areas today. And yet, if you really want to understand more about your financials, your profit and loss, how to actually grow a really profitable business, I recommend that you sign up for Profit Camp. The next one that we're going to have is January 26th, and that's going to be at 1 o'clock Central. So if you go to maps.kw.com, under the events tab, you'll see Profit Camp right there on the left-hand side. But with that, let's get started. So the 5 biggest mistakes. Oh, sorry. Number 1, cost of sale is eating your profit. And when we're talking about cost of sale, and I'll get into this a little bit more, that's going to be things like splits with other agents, your cap, your royalty, any concessions, maybe referral fees, things like that. The second mistake is not following the MREA budget model. Not following the MREA, the Millionaire Real Estate Agent budget model, is a big mistake that I see a lot of agents make. Number 3 is not cutting the fat, but cutting the bone. In other words, when we're making financial cuts, sometimes we're cutting the wrong thing and we actually think we're saving money, but it actually is a detriment to our business. The 4th thing is not reviewing your financials monthly. You don't know where you are financially unless you're actually looking at your finances regularly. So we're going to hit on that a little bit. And then finally is not creating a business budget. It's the perfect time for you to do it. It's the start of a new year. You're going to be able to create a business budget, and you can do this anytime throughout a year. Anytime you can create a business budget if you haven't had one yet. So, but I always recommend at the end of the year, before you start into a new year, decide now how much money you're actually going to spend. It's so easy to get caught into finding shiny objects and not really knowing where I am financially. So let's just go ahead and spend the money on this thing, but we really don't know where we are financially. So with that, let's go into number 1. The cost of sale is eating your profit. So the profit is going to be, everything that you make. You also have a cost of sale. You have business expenses to run your business, and everything that after that is actually your profit. So what we were talking about with cost of sale is eating your profit. Think of cost of sale like this. This is not 100% true, but it's about 99% true. Cost of sale. I'm asked often, what is a cost of sale? You wouldn't have had the cost unless you had a sale. So therefore, it's a cost of sale. You don't pay a split with your market center or royalty unless you actually had a closing. You don't pay a split with your buyer agent if you're a rainmaker unless they had a closing. You don't pay a concession unless there was actually a closing. You don't pay a referral fee unless there is actually a closing. So it's you have a cost because you had a sale. Now, there's a lot of things that people try to put in under cost of sale that actually don't belong there. But we dig deep into that in Profit Camp. So, but what I want to really focus in on today on this is what's happening with cost of sale with your splits. So the first one is the listing agent and the buyer agent splits are actually the same. So first, let's look at the MREA model that Gary recommends for us. What he says for your listing agent, it should be a base salary plus 10%. Now, in this example, I just use a base of $100,000. I'm not saying that you have to pay a listing agent $100,000. I just did this because, well, quite frankly, it's really easy math. So $100,000 is a base salary that I'm going to pay plus 10% commissions. Well, let's look at what would happen if we had a listing agent on our team and that's the financial setup that they had. Well, let's just say now our average commission is $7,500. So 10% of that would be $750 for every closing that the listing agent had. Well, if they sell 100 listings times $750 each, that would be an additional $75,000. So now their base of 100 plus the commissions that they got at 10%, another 75, your listing agent would be making $175,000 if you were at a base of 100 and if your average commission was 7,500. So use your math to figure out what it would be if you were actually following the model, base plus 10%. Now let me show you what happens when we're not following the model. The listing agent and the buyer agent splits are the same. So in this example, 50-50. I'm paying all my buyer agents 50-50, and I'm paying all my listing agents 50-50. Or I see people get tripped into this one often. I'm going to allow my agents to be hybrid agents. They can do buyers or sellers, and I'm just going to pay them 50%. Well, the problem with that is that you're really overpaying on the listing side. So now in this example, we're just going to pay them 50%. We're not going to pay them a base salary. All right. So the average commission is $7,500. You're paying 50% for every one of their closings. So for every closed unit that your listing agent is closing, they're getting $3,750. Now, if they still sell that 100 listings, just like they did on the previous slide, they're now making $375,000, and you have overpaid them from the MREA budget model by $200,000 because your splits are too high on the list side. So I'm often asked, well, why are the splits lower on the list side than they are on the buy side? And the reason for that is it takes about a quarter of the amount of time to work with one listing than it does with one buyer. So think of it this way. If we all worked 40 hours a week, 4 weeks a month, a strong buyer agent can probably close, pretty regularly about 4 transactions a month, because it takes almost about 40 hours from the beginning of when you got a lead to actually closing, being at the closing table. It takes about 40 hours. If we were pressing a chess clock every time that you had anything to do with that file or that client, it would add up to roughly on average about 40 hours. On the list side, it would, if we were hitting that same chess clock every time that we had anything to do with that listing, it would only really come out to about 10 to 15 hours. So therefore, a listing agent can do a whole lot more transactions than a buyer agent. But if we put them on the base plus 10%, and then the buyer agent on the 50-50, at the end of the day, they're going to work the same amount of hours as each other. And then they'd also make about the same amount of money. Here's another thing to be careful about. Keep this in mind. A listing agent, a buyer agent is not a stepping stone to one day grow up to be able to be a listing agent. It is not a stepping stone to become a listing agent. And I hear this one all the time is, I'm just going to bring on these buyer agents, and then once they've earned the right, I'm going to make them a listing agent. Well, first of all, they're at a 50-50 split, and now you're going to take them to a base plus 10%. That feels like a takeaway. But the other thing is a buyer agent and a listing agent are two very, very, very different KPA profiles. So hire the right person for the role, not call it a stepping stone to eventually becoming a listing agent. So I didn't have that one in the slides, but you can have that one for free. Okay, so in our example here, again, if you paid them 50-50 on the listing side, you are taking an extra $200,000 out of your profit from you and your family and taking better care of your listing agent than you are of your own family. So let's look at this one. What about when the buyer splits are too high? Well, Gary Keller says, if I give you a lead, we're going to do a 50-50 split. If I give you an appointment, it's going to be more like a 60-40, 60 to me, 40 to the buyer agent. But let's just look at the 50-50. So, and MREA recommends 50% as well. So in example 1, 50% split. Let's say that the buyer agent brought in gross commission before any cap, split, royalty, anything else, gross commission of $800,000 for the entire year. Well, if they were on a 50-50 split, that buyer agent would make $400,000. Now, I know that one buyer agent might not bring in $800,000 with a GCI, but you might have 3 or 4 buyer agents, and collectively they've brought in $800,000, okay, in gross commission. If we give them a 50% split, that means we're sharing 50% of everything that came in with our buyer agents at $400,000. Regardless of how many of them there are, this is how much all the buyer agents brought in. This is my 50% split that went out as cost of sale. So that's the MREA budget model. Now let's look at what happens when you actually take them to 55%. $800,000 in gross commission. Now we're paying them 55% instead of 50. Well, now you're paying them $440,000. So you have now overpaid your cost of sale. You've overpaid your buyer agents $40,000, which came out of your profit. Now, if you're a buyer agent, I want to say this. This is not to try to keep you small, try to make you not make enough money. What's happening here is that the rainmakers are actually not keeping enough money to be able to reinvest back into the business in order to help you to make more money. You see, it's not about the split. It's about the opportunity. It's about the value proposition for being on a team. As soon as we make it about the split, everybody loses. It's just like a seller. It's not about the commission that we charge. It's about how much money they can put in their pocket at the end of the day. Same thing with having a buyer agent or a listing agent. It's not about what percentage we'll give them, or they've been here a long time, I should give them a raise and take them to 55%. That's actually a very poor business decision. Maybe you should just give them greater opportunity. Maybe what we do is we hire them a showing assistant. Maybe what we do is we hire a transaction coordinator for them because they're doing so much. So really watch those splits. It's coming right out of your profit. Okay, what if they were at a 60% split? Now you're going to pay them 60% instead of the 50 originally. Well, same thing. We've got that $800,000 that the buyer agents brought in. You're paying them 60%. That's $480,000 that you're paying out in your splits. And you are now overpaying $80,000 that is not staying with you to reinvest into your business or create your life by design. I mean, I don't know about you, but I could use an extra $80,000. If I saw it on the ground, I'd certainly pick it up. I'd be able to find a way to spend that. I mean, that's a condo. I mean, come on. So really watch your cost of sale. It's really eating away at the profit out of a lot of our businesses. I see a lot of profit and loss statements from some very high producing agents. And I can tell you that oftentimes when their profit is low, I can go right to cost of sale and tell them why. Their splits are too high. They've allowed themselves to be handcuffed by their buyer agents or their listing agents that are threatening to leave unless they can get a higher split. Well, rainmakers, if that's what's happening with you, then you need to really take a look at how you're running your business and ask yourself, is my value proposition so strong? Would I provide to my team that they will stay forever at 50%, maybe even 45%, because my value, the value of being on my team is so much higher. So take a look at the value that you're offering if you're ever challenged on your splits. Okay, let's go to the next one. Number 2, not following the MREA budget model. This is right out of Millionaire Real Estate Agent book. But what you're looking at right here, this is the most recent updated version. So we all know, and we've heard that Gary has been working on the second edition or the revision of the Millionaire Real Estate Agent book. And so the research team at Keller Williams is constantly studying the numbers out there. And what I love about the budget model is that we have really brilliant, highly educated researchers and analysts that are constantly studying these numbers, which means I don't have to. They're actually doing the work for us, and they keep tweaking this a little more, a little more, a little more. And right here, what you see on the screen, I'm going to show you this slide in the next one. That's the budget model. That's the most current right now, as it stands today. These are the numbers that are going to go into MREA 2. So spoiler alert, you're seeing a little bit before the book actually comes out. And if you're asking the question, when is the book coming out? I don't know. And either does Gary, by the way. All right, so let's take a look at this. So the budget model, what we see here across the top these are the GCIs. So find the GCI that is closest to you. If you're selling about, I don't know, $600,000 a year, you're probably going to use this column of 640. If you're like right at $1 million, you probably use 970. So just find the one that's closest for you. Now, these 6 right here, well, these are the averages. What the researchers and the analysts have found is those that are making this much in GCI on this top line, on average, this is what they're spending in cost of sale, expenses, and their net income. Over here on the far right, these are best practices. So at $1 million, what Gary Keller and his team recommends are these numbers. And when you're bringing in 2.5 million, well, that's the Millionaire Real Estate Agent. So we hear a lot in Keller Williams about 30, 30, 40. So that's the millionaire real estate agent that they bring in 2.5 million in gross commission, and then they'd have 30% go out in cost of sale, 30% go out in expenses, which would leave them a profit of 40%. So wherever you are, don't worry about anybody else's columns, just figure out where yours are. And this is going to be a really good baseline for you to actually set up your budget and know, am I in budget? Am I out of budget? Am I really whacked? Am I doing good? Something that you might realize is, wow, my expenses are way lower than what this page is telling us right here, or this slide. Well, maybe you should spend some money to actually be able to make some money. So there's all different sorts of ways to increase the profit. And sometimes it's actually in spending some money. So let's just say that, like, maybe you're right in here, okay? 340,000 in GCI, and it says your expenses should be 36%. Well, if they're only 15, perhaps it's time for you to hire an executive assistant, or maybe a transaction coordinator, somebody that you can leverage part of your job to in order to give you time back. And as a result, you'll be able to do more transactions because you've used leverage to take some administrative things off of you and put it onto somebody else so you can focus on closing more transactions. So again, GCI is across the top. The next is the cost of sale, like we were talking about previously. And you'll see on each one of these that gives us the average amount as well as the percentage. So what we mean by the percentage is, like, for instance, let's just take column 1, 13%. What they're saying is, of the $150,000 of gross commission that you're paying, on average, you'll probably be paying in cost of sale. About 13% of that 150 is going to go to cost of sale, which would be $19,500. So that's what the percentages are. It's the percentage, the percentage in the column of the gross commission. So if you're at 640, 33% of everything you make is going to go back to cost of sale. Paying your cap, paying your royalty, paying commission splits with agents on your team and such. The next line is just, this is the gross profit. This is just showing you, okay, here's my income minus my cost of sale. Think of it, cost of sale it's kind of not your money anyway, because you know it's going to be gone when you actually have a closing. So your gross profit after your cost of sale, that's what this line is. It's just GCI minus the cost of sale, tells you how much you still have left. Next line is the expenses. And we're going to look at expenses just a little bit more in just a second on the next slide. We'll dig into those. So expenses, how much money outside of your cost of sale, what are you having to pay for office supplies, lead generation, the market center rental space that you're in, E&O insurance, all those things that you have that you're paying for in order to actually run your business. So this is the recommended amounts or percentages based on your GCI. And then of course, here at the bottom, the net income, or I like to call it the profit. This is how much profit you could anticipate if you stay within the budget model. So error number 2 that I see is that people are not following the budget model. It's already been done for you. We have highly educated researchers and analysts that are constantly going over these numbers. Take advantage of the heavy lifting that they're doing for you. So now let's look at expenses a little bit. So I know that this one might be a little bit hard to see, but I wanted to get it all into one slide for you. So the budget model includes under what you just saw on the previous slide, under here, if this is all on one piece of paper, below it would be this right here. And what this is a breakdown of the expenses. So in MREA, Gary Keller has 9 categories of expenses. We have compensation, lead generation, occupancy, coaching and education, supplies, communication and technology, automobile, equipment, and then insurance. Now, does every single dime that you spend slip right into one of those 9? Not always. Sometimes you just kind of have to shoehorn it in of where it makes the most sense to put it. But for the most part, these are the 9 categories that as real estate professionals where we're spending our money. So under compensation, let's look at this top section here. Under compensation, we have 2 subcategories. One is salaries and benefits, and one is professional services. Salaries and benefits, it's not just salaried employees. It could be hourly employees. It could be 1099 employees, your runner. What these are not are professional companies that you're paying. So for instance, it could be your executive assistant, your transaction coordinator, your marketing specialist, your runner. But what it's not is things like the photographer. I've hired somebody to take my pictures. Well, that's under lead generation. So these are the people that actually help you to run your team, to run your business. That's what salaries are. Next is professional services. Think of professional services. They're people that help you in their profession to run your business, but they're not really in your business, like a CPA, a bookkeeper, an attorney, things like that. Those are professional services. So those are the two categories that fall under compensation. The next category is lead generation. Now, just a spoiler alert, when I get to the bottom of this slide, I'm going to stop and take questions. So if you've got questions, jot them down and I will stop and answer any questions. Okay, back up here. Next, we have lead generation. This also has two subcategories. You'll see here we have general prospecting and marketing and also listing management. Now notice it's not listing manager. If you have a listing manager, that's a human. So they would be that their compensation goes under the salaries. Listing management is all of the expenses that you have because you have listings. So the idea here that Gary had is that he wants agents to know how much it's costing them to actually have listings so that we will quit taking overpriced, unsellable listings, because it actually is costing you something to have them. Oh, it's just another listing. I'll stick a sign in the yard. No big deal. It doesn't cost me anything. Actually, it does. So this is where you would put things like open house costs, signs, photography, if you do just listed cards, things like that, any cost that you have for having listings goes under listing management. Everything else that you do that has to do with prospecting or marketing would go under general prospecting and marketing. So if you pay for Zillow leads, that would be general prospecting and marketing. Your business cards, Google pay-per-click, Boomtown, Facebook ads, that's general marketing. That would go under that. But all together, that's all lead generation. But Gary just recommends that we split it out. What is it costing you to have listings? And then what's the rest of all of your marketing and advertising? Couple of really quick things here. Your stager, I know it's a human being, but the reason that you stage your home is to make it more appealing, which makes you have more leads. So therefore it's lead generation. Photos, you take photos of the home so that people will actually click on them so that you get more leads. So that's lead generation. And I know that those are human beings, but they're not salaried. Now, if you have a full-time photographer on your team, I would recommend that you put their salary actually under prospecting and marketing. And we can dive more into that later if there's any questions around that. The other question I'm asked is, where does transaction coordinator go? Does it go under cost of sale? Because I don't pay my transaction coordinator unless I have a closing. I highly recommend you still put it under compensation. Put it under compensation, because when our researchers and our analysts came up with the budget model, they didn't come up with these numbers based on you having transaction coordination up under cost of sale. So if you put it there, just know your cost of sale is going to be high and your salaries might be a little bit low. So let's keep going. So next we've got occupancy. Occupancy is just the dirt beneath your feet. So if you have a cubicle, if you have office or offices, or you have a mega agent office, this is your occupancy. Now, this is not the costs of, you have to pay tech fees and copier fees and all the printing that you do. That we're just talking about the ground, the area that you've rented to run your business. So it's probably just going to be like your office, maybe if you've got some cubicles. The other thing that I see under occupancy sometimes is if you have a storage unit because you stage your own properties, that storage unit, that's ground. So that's what would go under this. Next is education and coaching. Any classes that you take, any CE credit. Remember back in the olden days when we used to travel to family reunion and mega camp and masterminds, not only did you maybe pay for a ticket to that, But also if you flew there, if you ate there, if you had a hotel there, all of that is a cost of your education. So that would go under education and coaching. If you have a MAPS coach, it's going to go under education and coaching. Supplies and office expenses. I think of it this way. The office bill that you get, besides what you're paying for your space, the office bill from your market center, those fees could go under there. But also this is like things that you're going to go to OfficeMax to buy. These are your office supplies. So paper clips and paper and pens and pencils and whatever those kind of office file folders, things like that. That's what's going to go under office supplies and office expenses. Communication and technology. This is going to be your cell phone. If you have a dialer or a triple dialer, any technology that you use in order to actually run your business is going to go under tech and communication and tech. Automobile. This is one that people get tripped up on. Unless your company, if you have a corporation, an LLC, an S Corp, unless they actually own the vehicle, you should not be paying for your vehicle, even though you use it 90% of the time for real estate. You shouldn't be paying for it with company dollars, and it does not belong on your profit and loss. So under automobile, notice that the percentages are really low. Well, that's because it's only going to be covering things like parking, tolls, maybe some mileage reimbursement, things like that. Equipment and furnishing, well, that's exactly what it says. That's going to be your computer, your desk, your chair, your lamps, things like equipment that you have to run your business. And then finally, insurance. Again, this is not auto insurance. It's not health insurance. This is going to be like your E&O insurance, or I know a lot of you have to have like an umbrella or an additional insurance because you actually drive people around in your car. So therefore you have to have an extra insurance policy for that. That's where this would go. Okay, we've covered cost of sale and we've covered the budget model. Now, we didn't go super deep into either of these, but if you've got some just kind of high level quick questions around this, go ahead, unmute yourself, and we'll just take a couple of minutes and answer any questions before we go on to error number 3 or budget mistake 3. Who's got a question? Anyone?
Hey, Jeannie, I got a question. Can you hear me?
I can. Go ahead.
Yeah, you mentioned that like technology, Boomtown, or those types of things would go under technology. I'm curious why it wouldn't go under lead generation.
Yeah, so that's a great question. So a lot of our CRMs are kind of like, do I put it under tech or do I put it under lead gen? So there's not a really clear line in the sand for this one. If you're using it for as your CRM, and primarily for that, to track all your people, your transactions, you've made the holiday calls, you've called them on their birthday, things like that, I would put under communication and technology. If you're using it like in Boomtown, you're getting leads from it, or I think there's several, these CRMs that you can also get leads through it. You could put it under, I would probably recommend that you put it under lead generation.
Awesome, thank you.
Kind of what's your primary use for it? Great question. All right, any others?
Yeah, this is John Rubino. Under occupancy, what if you own your home and you have your office in your home? How does that work?
Yeah, John, that's a great question. So IRS rules, and you need to talk to your CPA or your accountant about this, because IRS will allow you to write off a certain amount of space and also a certain amount of your utilities based on the square footage of your home and how much you actually use. So talk to your CPA about that, because they've got a little calculation to be able to figure out how much you can actually write off. So great question, especially these days. A lot of us, I work from home full time. So yeah, a lot of us in the current days that we're in are doing exactly that. So great question, John. You can write some of it off. Just make sure that you talk with your CPA or accountant in figuring out the amount.
But what goes into the model here? Just leave that blank?
Under occupancy, I would put anything that you can actually, under occupancy, I'd probably just leave it blank. You're not going to have any costs. You'll have a tax benefit, but you're not going to actually have a cost here. So I wouldn't put anything on your profit and loss for it.
Okay, great. Thank you.
Yeah, great question.
Sherry McGuire, I have a quick question.
Is it Sherry?
Sherry? Yeah.
Okay,
Just
Sherry.
a real quick question. Realtor association dues, things like that. Where do we put those?
Yeah, I would put those under education and coaching.
Okay.
because again, that's a great example of where do I shoehorn this one in, my dues. Well, sometimes you just have to kind of go through these and think, okay, well, are my dues a person that I compensate? No, so it doesn't go under compensation. Do I have to pay dues for lead gen? No. Is it rental space? No. Is it an office supply? No. Is it automobile? Clearly not. So sometimes I guess the best place it's going to fit is going to be under education and coaching. So here's the important thing, and this is a great question, Sherry. Wherever you put it, stay consistent throughout the entire year.
Okay.
Here's one that I get a lot. Where do I put my bank fee? My bank charges me $7 a month to actually have a checking account with them. So there's nothing on here that says bank fee. So I put it under office supply because in order to have checks, I have to pay this amount. So it kind of feels like that's the best place to put it. So I put it under office supplies, but the most important thing is that every single month it stays under office supplies to keep it consistent throughout the entire year.
Okay, thanks.
Sure. Okay, let's do one more question. Anybody else? Okay, let's do 0 more questions and let's keep going because I got a lot to cover here. Number 3, let's talk about this one. Not cutting the fat and yet cutting the bone. I stole this from the author of The Road Less Stupid, Keith Cunningham. He talked about cutting the fat and not cutting the bone. The fat is things that you're paying for in your business that you really could live without. And I know a lot of us went through major budget cuts when COVID hit and we had to get really lean really fast. But what I've seen is a lot of people start cutting the bone. In other words, things that are actually a detriment to you not having on your team. Cutting out, people that had been doing, let me just give you an example. Somebody that was doing postcards and they'd done them for years and they were doing them every single month. And they did postcards because mail continues to work in the demographic where this person was actually working, and they cut doing the postcards. All of a sudden they started losing market share because they cut something that was actually detrimental to their business. Another thing is I think I can live without a transaction coordinator. I'll just have my executive assistant start doing all my files. Well, we just cut a human out of it. That's really cutting the bone rather than cutting the fat. So go through your budget and look at what you're paying for that you could actually either do without, or maybe you need this thing, but you can do it for less money. So here's the mistakes I see: not looking at your expenses and where they've actually gotten a little bit fat. It's a very slippery slope that if we're not looking at our expenses regularly, all of a sudden one day we're like, oh my gosh, I'm paying for all this stuff and I'm not even sure what it all is. When I've gone through this process with people, going through their budgets with them, and we go line by line every dime spent, there's oftentimes that this is the conversation. So-and-so, tell me, what is this that you're charging every single month to Apple, $5.99 4 different times? What's that for? And they're like, I don't know. Okay, well, let's find out what it is, because it's $5 each and it's happening 4 different times. That's $20 a month that you're paying for something that you don't know. Well, if we took 20 and times it by 12 months, we're talking a lot of money. So watch out for it. It's only $5. It's not that big of a deal. Really? If you were walking down the street and you saw a $5 bill, would you just step over it? Hey, it's only $5. It's not that big of a deal. You pick it up and put it in your pocket. So same thing with our business. Let's cut the fat and let's make sure we're not cutting the bone. But the way to cut the fat is you got to look at what you're actually paying for right now. The next one is letting go of good administrative talent. That's cutting the bone. The next one, not renegotiating your contracts with your vendors. A lot of vendors are willing to renegotiate. They'd rather negotiate and have you pay less than have you not pay at all. So pick up the phone, call the vendors and ask them if they'd be willing to do something for you. And then finally, hanging on to the fat because it's convenient. I'm paying for this thing. It just makes my life so much easier. And let's face it, sometimes we hang on to these things because we're kind of lazy, but we could do without them. I encourage you to get as lean as you possibly can without it becoming a detriment to your business. There's one team that I coach. This is a true story. They cut $10,000 a month out of their expenses. A month. So that's $120,000 a year. In about October or November, I said, okay, we've cut this back in March, $10,000. We've gone several months now. What has been the impact on your business or on your clients for cutting that? And they said, actually, our clients never even noticed it. So we were paying an extra $10,000 a month that really wasn't doing anything for us. So take a look at, interrogate. You work so hard for every one of your dollars. You deserve to know where it's actually going. So hold those dollars accountable, because every dollar you're spending is a dollar that you're not taking home for you, your family, your vacations, your retirement, things like that. All right, number 4, not reviewing financials monthly. This is your profit and loss statement to start with. So your profit and loss is, here's all of the income that went in, here's my cost of sale and my expenses that went out, and then you can see what is your profit at the end. I recommend that you every month look at your monthly profit and loss statement. So let's just say that if it's May right now, May 15th, you'd be looking at the previous month, right? So you'd be looking at April, because once the books are closed for the month, you get the monthly P&L usually around the 15th if you have a good bookkeeper. Look at the monthly report, look at everything that was spent, make sure that we're not paying for anything that we don't want to be paying for. Then also look at year to date. Where are you for the year based on your budget? Remember, that's number 5, that the mistakes that they don't create a business budget. So where are you? Are you in alignment? How are you doing on the percentages based on the MREA budget model? This helps you keeps you from spending where you shouldn't and allows you to spend where you should. There is no successful businesses that don't review their finances monthly, if not weekly. So look at your money, get to know your money. Where is it going? You deserve to know where every dollar went. The next is, you also should be reviewing your budget. Are you staying within budget? There's a team that I work with that they do a lot of luxury properties. So we've created a luxury lead generation, or actually the luxury photography budget for the year. So we're going to watch all throughout the year. And remember, we've got a whole 12 months to go. So let's make sure that we're not overspending in advertising our luxury listings. And we're also not underspending, because we've got to stay within budget. And then finally, your balance sheet. Your balance sheet is actually the health of your business. What are your assets? What are your liabilities? What's your business actually worth? So review your financials monthly. If you don't know how to review them, get a coach, get somebody who specializes in the P&L, work with your CPA, work with your bookkeeper. They will help you to actually understand what these numbers are. All right, and then finally, not creating a yearly business budget. So first item, if you are unaware of how much you need to spend in any one area, how will you know if you're making the right spending decisions? If you're unaware of how much you should be spending in any one area, let's say lead generation, how are you going to know if you're making the right spending decisions? If you know you're going to spend, if you have X amount of dollars for equipment this year, how do you know, unless you're looking at your numbers, how much more you have in your business budget? Can I buy that new computer this year, or should I wait till next year? Should I buy that new printer, or should I wait till next year? Oh, we've got a whole budget. It's November. We haven't spent any of it. We can actually go buy the 2 computers this year. You got to know what you are planning at the beginning of the year so that you can make sure that you're on track throughout the year. The second one ensures that you're spending money on the right things. When you have a business budget, it helps you to ensure that you're spending money on the right things, and it keeps you away from the shiny objects. So here's a dirty little secret. You know, all those agents in your market center that all of a sudden they've got the new thing, whatever the thing of the day is, and everybody seems to be buying this shiny new object, and it's just going to change their entire world. Just because they're buying those things doesn't mean that they're actually running profitable businesses. I've seen a lot of the profit and loss statements. A lot of them are not as profitable as they might look like they are, and they've got all sorts of fancy things and widgets and twinkly things, but they're overspending. So just because everybody's buying something, don't get tricked into that. This is going to give you the ability when you have a business budget to say no to the things that you should say no to, and yes to the things that will actually move your business forward. And then here's the final one. You've got to understand your return on your investment. We refer to that as your ROI. So the return on the investment. So if, let's just say you're paying for Zillow leads, how do you know if you're getting a return on that, whatever you're paying for those Zillow leads? How do you know? You gotta be looking monthly and throughout the year to date, every month. What's our return? What's our return? What's our return? Because oftentimes what we find is that it's not giving you the return that you think it is. Also, this is a sales gimmick. Hey, if you just sold 2 more houses using our fancy new widget, that would more than pay for the widget. Don't get sucked into that. Don't get sucked into that, because the math doesn't work, but also that's not really a good way to run a business. You should actually know what your return on the investment is going to be and be studying that to make sure, should I continue on with this? So let's go back, and I'm not picking on Zillow, but they just came to mind. So I'm paying for Zillow leads. So the way that you determine what's your return on that investment is you take the total gross commission that you've made as a result. So if I bought Zillow leads and I'm tracking where did my business come from, and I made whatever, $100,000 because I bought Zillow leads. That's the GCI that I made before any cap, split, royalty, anything like that. How much money did you make because you purchased those Zillow leads? Or it might be, you could be looking at what's my ROI on my past clients in my sphere. Well, how much money did you spend on loving on your sphere and doing pie deliveries at Thanksgiving, whatever you spent on that, and how many transactions did you get out of that? Calling your sphere, asking for referrals costs you $0. Zillow lead costs you hundreds of dollars. So let's look at where is your greatest return on your investment, which is going to show you where you should put more of your marketing dollars. So here's how you do it. The gross commission that you got, so you've got to track, where did all my business come from? How much gross commission did you get? Minus what did it cost you to get it, divided by what did it cost you to get it. So when we have the gross commission, let's just say, I'm just going to use really easy math here. Let's say I paid $100,000 for leads, which is crazy too high, but just for example, I paid $100,000, or I paid $50,000 for the leads, but I made $100,000. Okay. So I sold $100,000 worth of GCI, but it cost me 50. So I'm going to take GCI of 100,000 minus 50,000 divided by 50,000. You see, we first minus what it cost us, because now we're at our break-even point. So now everything left over, we want to know, okay, now take that and divide it by how much it costs us. And that's going to tell you the percentage of your return. So Gary Keller tells us he'd like to see a minimum of 4% on everything that you're spending money on, including your staff, by the way. If you hire an executive assistant, they should bring you 4 times, your income should go up 4 times what you're paying them, because you're leveraging, you're getting your time back by paying them a salary. You use that time to go do more business. So let's just stay again with something easy like Google pay-per-click or Zillow leads or Boomtown, whatever that is. Gross commissions that you made minus what you paid for it, divided what you paid for it, will tell you what your percentage is, what your return on your investment. So is it, Gary Keller says, at least a 4 to 1. So for every dollar you spend, you should get 4 back. So internet leads, most internet leads, you're going to find they only come out to about 1 to 2%. Sphere, past clients, that comes out to anywhere like 50 to 65 to 1. So when you understand your ROI on all of your lead generation sources, think how clear it's going to be for you to go, oh my gosh, we're spending all this money here for only a 2% return and this money here for a 50% return. I mean, probably every one of my 12 grandkids could tell you which is the right decision on that one. So that helps us, and it gives us clarity to know where we should actually be spending our money. All right. Any questions? Any questions? We've got a few minutes. So any questions you've had on any of this or anything about profit or P&L, I'll answer whatever I can.
Hi, Jeannie. This is Tony in Salt Lake City.
Hey, Tony.
Hey, you were saying 4%. Were you meaning a 400% return or a 4% return? And I'm just
Yeah.
not understanding.
It's a 4-to-1 return. So for every dollar you spend, you should be getting 4 back. So if you're
Thank you.
spending 100, we want to see you get $400 back. So it's a 4-to-1, not a percentage.
Thank you.
Great question. Thanks, Tony. All right. Anyone else? Okay, while you're thinking of questions, look at the slide here. If you're interested in really starting to understand your finances at a deeper level, and in Profit Camp, I teach you about personal finance, business finance, and then life by design finances. So you can go to mapscoaching.com. Under events, left-hand side, it says Profit Camp, and our next one is January 26th. It'll be from 1 to 4. It's just a 3-hour course Central Time, and I'll be teaching it many times throughout the year, but I know for sure our first one's going to be in January. All right,
So
any
the-
other questions?
Yes, this is Anna Petahovich. The example you gave for Zillow, where you spend $50,000, you got $100,000 from that 50,000.
Mhm.
Why are we dividing 50,000 into 50,000? I didn't get that piece of it.
Let me go back to that slide. Oh, right there. Okay, so it costs you 100,000. That's your GCI right here, right? Okay. So Anna, it costs you 100. Well, we want to know, well, what's your break even? Well, to make that 100, I had to pay 50. So I'm going to take 100 minus 50, left me $50,000 in profit, or in this is how much I made after I paid for my Zillow leads. I made 50.
Right.
Okay, so now I can determine, if you now divide that by the cost of the source again, it's going to tell you how many dollars you're getting for every dollar you spent. So now you're going to divide that 50 by 50 and it comes out to 1, right? So for
Right.
every dollar you're spending, you're actually making $1. So it's a break, you're not making anything.
Okay.
So let's do it this way. Let's say you made 100, you paid 25. Okay. So now you'd have 100,000 minus 25,000 is 75,000,
Right.
right? Divided by 25,000, because that's what your cost. Now you know your return is 3-to-1. You're making $3 for every $1 that you spent. People have a hard time kind of wrapping their head around this. So what I recommend is playing with it. Just play with it. And the more you play with it, the more you'll start to understand it. It's really quite simple, but it's kind of hard to wrap your head around. The first thing you have to know is I got to break even. So if it costs me, if I only made $100 and it cost me $100, I'm not making any money doing this. Why keep paying $100 just to make $100? You know, I'm not, if I say to you, hey, if you give me $1, I'll give you $1 back. Would you do it? Well, of course not. But if I said, hey, if you give me $1, I'll give you 4 back. Would you take that? Sure, I'll take that every day. So that's what we want to know is if you're giving somebody $1, what are you getting back? If you're only getting back $1, you're not making any money. You're just kind of trading money and getting germs on your hands. So
Thank
good
you.
question. Anna. Good question. All right. We've got time for one more. Anyone else?
This is Janet Johnson from Chattanooga.
Hey, Janet.
Not only are you not making any money if it's $1 for $1, but you've also got the opportunity loss of that money as well as the energy that everyone put into it.
That's right. That's a great point, Janet, is not only, remember, your time is money. That would be a great exercise to go through. In fact, maybe I'll add that to Profit Camp and I'll credit you, Janet. What's your dollar per hour? How many hours are you working? And then how much money did you make? Okay, well then let's figure out what's your dollar per hour. And if let's just say your dollar per hour is coming out to $100 an hour. And you're just wasting time going and getting the energy to pay $1 so that you can get $1 back. If you spend an hour doing that, you actually lost money because you could have used that same time to just go get one more piece of business. So a lot of energy is lost, a lot of time is wasted, and your worth, you have a worth of $1 per hour. That's an exercise that I do with people a lot, is figuring out your dollar per hour And then going through your calendar and looking at it, everything that you're doing or that you did, is everything on there worth the dollar per hour that you're worth? Or should you leverage that off to somebody else? Going and chasing around that plumbing bill so that something can close tomorrow is probably not worth $100 or $200 per hour. You could probably find somebody else to do that. That's a good way to cut the fat and not the bone. So great point, Janet. All right, anybody else? Okay, well then with that, we're gonna wrap it up. So thank you for being on this course. Remember, you deserve to know where every single one of your dollars goes, because if it's going out to somebody else, it's not coming back to you and your family. So if you'd like to know more, sign up for Profit Camp. Love to have you in there. January 26th at 1 Central. So with that, I'm gonna sign off. Thank you, everybody. Have a great rest of your week. Bye-bye.
Thank you. Happy New Year.